Hi, this is Mark Anderson, Home Lending Officer at Carrollton Bank in St. Louis, Missouri. I also write the website bestmortgageanswers.com. You can find all my contact information there along with a lot of useful mortgage information like the information that I hope to cover in this video. What I wanted to do was just create a broad subject video on what all is involved with choosing a mortgage program. I think that the industry makes it seem like it's as simple as just choosing a rate and a fee and the guy that you want to go with, but there's a lot of moving parts to your choice for a loan. There's a lot of complexity to it, and I wanted to walk you through all those different steps. I'm a big believer in just being really transparent, providing a lot of information to my clients, because I think that with that information comes a level of confidence. There's a lot of decisions that you've got to make in this process, and I'd rather that my clients make those decisions confidently, knowing that they've looked at all of the available options. So that's what we're going to do now. The first thing you've got to do when looking at a loan is determine what type of loan you're looking at. So it is not true that there's just a 30-year fixed loan and a couple other programs. There's actually kind of broad categories, and the first broad category is the actual program type. So there are two main categories. There are conventional loans and there are government loans. Government loans include FHA loans, VA loans, and USDA loans. Now, why would you choose a conventional loan or an FHA loan or one of these others? I'm going to touch on this just briefly. In general, a conventional loan is going to make the most mathematical sense for the borrower that has a good to great credit score and is making a significant down payment. So if you're putting, let's say, 10% down or more, and you've got a 700 plus credit score, I'm betting that when we run the numbers that the conventional loan option is going to make the most sense financially. It's going to be the cheapest overall payment. Now, if you have a lower credit score than that, or if you're making a smaller down payment, FHA allows you to do a 3.5% down payment, and it's not really credit sensitive when it comes to the actual interest rate that's out there. So you can get a fantastic interest rate with a credit score even into the low 600s. In my experience, if you've got a 620 plus credit score, you can typically get approved for an FHA loan, or at least be in the ballpark of their approval guidelines. Whereas conventional, that would be a little bit tougher. VA loans, I'm going to make a broad categorical statement. If you are a veteran or an active duty service member that qualifies for a VA loan, it's almost certainly going to be the best loan for you to do. Now, one thing to be mindful of, there are a lot of lenders out there that don't have a lot of experience with VA loans, or perhaps the company that they work for simply doesn't offer them. They may try to push you in the direction of a conventional loan, but I'm telling you, 99 times out of 100, if you are a veteran or an active duty service member that qualifies for a VA loan, it's going to make the most sense. And you need to at least make sure that you've looked at the numbers for a VA loan. The big thing about VA, the obvious thing, is no money down, 0%. And not only that, you have no PMI. There is a funding fee that gets tacked on to your total loan amount. Unless you have a qualified service-related disability, then that fee is waived. But no money down, no PMI. It's really hard to beat. It's a great benefit for veterans and active duty service members. And finally, the last government program is called USDA. It is a program that is specialized for rural property, and it has very favorable terms for properties that are in qualified rural areas. Okay, so let's say you've generally determined that you know what type of loan you're going to go with. You're going to go with a conventional loan. Next thing you have to determine is the term on the loan. Well, what is the term? The term is really just the amount of time that your loan is set up to be paid back over. The most common term that people take is a 30-year term. This is a loan that you're going to start paying on day one, and it won't be paid off until you either sell or until you make that last payment 30 years down the road. Now, there are other terms out there. You could say take a 15-year term. Okay, well, why would you do that? Well, number one, you pay it off a heck of a lot faster. Number two, the interest rate that's going to be associated with the 15-year loan is going to be lower than the 30-year. Let's say, for the sake of illustration, that the going 30-year rate at one given time is 4.5%. Now, this rate is just being used for illustrative purposes. It's not meant to be reflective of rates that are available in the market right now. It's just used to make a point. 4.5%, let's say that's the rate at the time on the 30-year fixed. You might be able to get a rate as low as 3.5% on the 15-year. So by taking that shorter term, not only do you pay the darn thing off faster, but you get a benefit of that interest rate. Well, there is a catch. The catch is, with that faster pay term, as you might imagine, the payment's going to be significantly higher. And so if you're looking at one of these shorter term loans, it pays to do the math, make sure it's going to be a payment that you can afford. No one is telling you that you can't pay off a 30-year loan in 15 years. You absolutely can. You don't get the interest rate benefit, but you can choose to pay it off faster. The vast majority of loans, I certainly don't do any of these, the vast majority of loans don't have any prepayment penalties anymore. So the benefit of taking the 30 years, you don't have to pay it off faster, but you certainly can. It should also be mentioned you can get odd term loans. You can get a 27-year loan. You can get a 17-year loan. There's some different things that you can look at there to make sure that you're getting the best loan for you. Next up, we've got to make a determination of whether or not you're going to take a true fixed rate loan or whether or not you want to look at an adjustable loan. Now, as soon as you say the word adjustable, people get a little uncomfortable. Before the financial crisis, I'm here to tell you there were some truly bizarre, wacky, not good loan programs that were adjustable rate loans. I think, were truly designed to cause people to fall into foreclosure. They were designed to fail. They're definitely very predatory. With a lot of the regulations that came in after 2008, those loans, as far as I can tell, are gone. I know I certainly don't even have access to anything that would be seen that way. And so here's just a quick explanation of why you should maybe consider at least looking at your options for an adjustable. So we'll go back to that same 30-year timeline. So on a fixed rate loan, you've taken a 30-year term and you've said you don't want that rate to change at any point in time. All right. Now that makes sense if you plan on living in the property for 30 years or holding the property for 30 years. You want to protect yourself against rates going up in the future. Well, what if it is not your intention to live in the property for 30 years? What if it's your intention to be there for 10 years, 7 years, 5 years or less, and maybe you're darn sure that you're going to be out of that property or you're going to sell that property within that time frame? Well, if you think about it in that case, you're actually paying a premium to take that 30-year fixed rate. What I would recommend instead is let's look at another option. So there's the same 30-year payment schedule. So your payment's still based on a 30-year payment schedule, but the loan, it's called an ARM, an adjustable rate loan. It's actually called a fixed adjustable hybrid ARM. It's a mouthful. We just call it ARMs for short. An ARM is represented with two numbers. You're going to have one number in the front, you're going to have a slash, and then a 1 in the back. Now this number means that the rate that you start with is going to be fixed for that number of years. So in the case of a 7-year ARM, you get a rate for 7 years that's locked in. If you sell or refinance that property within that 7 years, you get to take benefit of that rate without needing to worry about it adjusting. So let's say it would adjust here. The rate's going to be significantly lower in most cases. Let's say in this case it's a full 3/4 of a point lower. Again, these rates are just used to illustrate a point. They're not meant to be reflective of actual rates available today necessarily. So that rate you would have the benefit of for that 7 years. If you're going to be gone by year 7, you'd be paying a higher rate, a higher payment, and you wouldn't get the benefit of having that 30-year fixed rate term. Now, let's say plans change. At year 7, you're still there. Well, that's where this number comes into play. What that number says is that every year, every 1 year after 7, that loan rate adjusts. So it adjusts on an annual basis. It adjusts for the first time right at that 7-year mark. Most ARMs have a lifetime cap and a first initial adjustment cap. And most of the time, that is going to be 5%. Now, what determines the actual rate at the time of adjustment is very complicated and we won't spend a lot of time on it. But basically, there's an index. That index, whatever that is at the time, is used to determine the actual rate. But you're protected against too much of an increase by that cap. So maybe in this case, if it were to adjust, it might adjust as high as the overall lifetime cap all the way up to 8.75. So there is a danger in taking these loans if you're not certain that you're going to be gone before that adjustment takes place. If you're certain of it, you're going to save a lot of money by going that direction. Okay, next up, private mortgage insurance, PMI for short. Most lenders do a not so great job of explaining options. Most have the monthly option as if that's the only option that's out there. Well, I ran the numbers about 10 years ago, comparing some other options that actually a representative of a PMI company put in front of me. He said, we've got these other programs and nobody really seems to use them. Everybody's using monthly. I really think you should look into it. Well, I did, and I'm going to tell you that the math works out really, really well for these other options. And most of my clients at the end of the day, when we look at all three scenarios, they're going to choose either the single premium or the lender paid premium because it ends up being a better deal. So monthly premium, that's a pretty easy concept. You're going to pay a monthly amount. Let's say in this case it's $100 a month. That's if you put less than 20% down. And you're going to pay that $100 a month until your principal balance reaches that 20% equity mark. And then that monthly PMI premium is going to fall away. Well, what we want to compare that to is a single premium first. Single premium allows you to completely avoid ever paying the $100 a month by paying a lump sum at the closing table. And let's say in this case that lump sum amounts to $3,000. Now, what we do when we look at this is we take the monthly, we take the single premium, and we try to figure out what your break-even point would be on the investment of paying the $3,000 up front. In this case, it's about 2.5 years. So as long as you run the property for 2.5 years, you're going to beat mathematically the monthly premium option. It's just going to be a better overall scenario and a cheaper monthly payment because you're not paying that $100 every month. Now, let's say you've already scraped for your down payment. You didn't come up with 20% down. That's why we're dealing with PMI in the first place. So maybe money's a little bit tight. You can, if you have a realtor that's comfortable negotiating not just price, you can actually negotiate the seller to pay this on your behalf. And I really recommend looking into that because the amount of money that you're going to save by negotiating a $3,000 concession from the seller to pay your single premium PMI is going to be a heck of a lot better and a heck of a lot cheaper than getting $3,000 off the price of the home. So I really recommend looking into that. Now the third option, which is certainly worth looking into, but I'm going to tell you it's going to sound crazy when I say it. Let's say that the rate for the monthly PMI option was 4.5%. The rate for the single premium option is going to be the same at 4.5%. The lender paid option is going to be a higher rate because that's how we end up paying the PMI on your behalf. We take a higher interest rate. Now I know that sounds nuts. Let's say in this case the interest rate's 5%. Well, I'm a big believer in just letting the math do the talking. And at the end of the day, here's the advantage. By taking the lender paid premium, you avoid having to worry about coming up with $3,000 out of pocket. You don't pay the $100 a month. Yes, there's a higher rate, but the actual difference in your payment needs to be quantified. It needs to be calculated. And most of the time when I run the numbers for people, it's better than monthly. And if they can't afford the single premium or they can't negotiate for the seller to cover it, it's the next best option. And long story short, like I said in the beginning, the monthly PMI option for the vast majority of people that I've worked with ends up just mathematically not being the best choice. All right, special programs. Just very brief, a couple things to be aware of. If you are looking at high dollar property, you may be looking at a non-conforming or otherwise known as a jumbo loan. The actual amount of the loan that triggers it being a jumbo or a non-conforming loan is based on where you're at. But in most of the country, the line in the sand is at $424,100. As soon as your loan amount goes above that, you're looking at a jumbo loan. Well, jumbo loans sometimes carry a higher interest rate. They're a little bit trickier to qualify for. The guidelines are very stringent. You've got to be a real A-plus type borrower with great credit, great assets, a good down payment, typically in order to qualify for a jumbo loan. You also really want to make sure, if you're looking at one of these loans, to work with a loan officer that's done them before. Because if they don't have experience with them, the guidelines are tough. And you really need somebody on your side that knows what they're doing with these jumbo loans. Next up, first-time homebuyer programs. Depending on your state, there may be state programs that allow you access to down payment assistance. So that's worth looking into. In Missouri, we have a program called MHDC. In Illinois, right across the river, we've got a program called IDA. It's essentially free money. It's a little bit more complicated than that, and it makes sense to look at it in detail. But if you're a first-time homebuyer, you should inquire about that. Next up, rehabilitation loans, renovation loans. Let's say you are not finding what you're looking for at your price point, but boy, there's a property down the street that just needs a little bit of love and care and some renovation, and you're going to get a really good deal on it and not have to put that much work into it to get it up to snuff. You may look at a rehab loan. The most prominent rehabilitation loan is the FHA 203K program. There's also another program called a Home Path. That's a conventional renovation program. These loans, I'm going to be straight with you, they're not for the faint of heart. They're a little bit tricky. They're difficult. There are a lot of responsibilities on your side of the table that have to get done, like picking the contractor, deciding exactly what work you want to do, etc. And so whenever I do these loans for people, I really sit down and make sure that they understand all the nuts and bolts of it, because it's not a cakewalk. And I'd be doing a disservice to anybody by saying that they were. For the right person that's ready to go with it and knows what they're getting into, it can be a great way to get to get a really good deal on a property and build it out the way that you want. Make the choices for the tile that you want and the appliances that you want. Finally, one of the reasons I'm really happy to work at a bank is I have access to what are called portfolio loans. Portfolio loans refer to any loan that does not fit in the box. Well, what's the box? The box is the large national mortgage agencies, Fannie Mae and Freddie Mac, that essentially write the rule book for mortgages. There are some interesting arbitrary lines in the sand where you could have a borrower that's very likely to pay the loan back. They're a good credit risk, but the guidelines just aren't set up for them. Maybe you've been self-employed for less than 2 years, and so you're not going to fit in that box. Or maybe you've got some unique credit situation that with the right company can understand where you're coming from and can make an informed decision on your ability to repay the loan, because the bank's lending with its own money. So that is interesting for people that don't necessarily fit in the typical box. The downside of portfolio loans is typically you're not going to end up with a 30-year fixed option. Because the bank's lending with its own money, typically the rate's going to be higher. So it's not going to be anybody's first choice, but there's some interesting things you can do with a portfolio loan. Next up, rates and fees. I put this at the end for a reason, and it's because I think that the industry is too focused on telling the consumer that the only thing that matters is the rate you pay and the fees that you pay. I hope that I've illustrated that there's a lot more to this. There's a lot of decisions that are made that have really nothing directly to do with the actual rates and fees. Obviously, it's still very important. More importantly, it's critical to get the details right. Now, I put the word interest rate in big type down here at the bottom because that is most of the time the number one thing that people are interested in. But I want to use this as a way to point something out. The interest rate that a lender offers, if all you know is that a lender is offering 3.5%, I can't tell you whether or not that's a good deal or not. And I'll tell you why. Because if I don't know what the lender is actually charging you to get that rate, it may be the worst deal I've ever seen. Because if you're paying exorbitant closing fees just to get that lower rate, and the guy down the street can give you a 3.75, or I can give you 3.75 maybe, and not charge you the exorbitant fees, when you run the math on it, this may end up being the bad option. So you need to look at all these things together. Now, it's also important to know that the majority of the closing costs you're going to pay at the closing actually have nothing to do with the lender. Now, we may estimate them differently. I may estimate the third-party closing costs differently than the guy down the road. But at the end of the day, there are independent contractors like appraisers that they determine what their invoiced fee is. The title company, we don't control them, and neither does the guy down the street. So you don't want to use the third-party costs as a way of comparing lenders. You can make your own comparisons to, say, a title company, for instance, but when making a comparison between lender quotes, you don't want to use those third-party fees as a basis of comparison. I'm going to make a whole other video talking in detail about how to compare quotes accurately, but suffice to say, what you need to compare quotes are the lender fees and the actual interest rate involved. Finally, you've got escrow. So escrow is a holding pen where you have payments that go into an account for your taxes and your homeowner's insurance. Most of the time the lender is going to want to set up an escrow account because they need to make sure that those bills are being paid. Long story short there, you pay a monthly amount into an escrow account along with your mortgage payment, and at closing you're going to have an amount that goes into the account to get it started. The math that's used to determine that exact amount is the same from lender A to lender Z. Again, up front, we may calculate it differently because we're not using the same inputs, but at the end of the day when the actual closer's working up the file, that's again not a point of comparison between lender A and lender B. It's going to be the same math at the end of the day. So putting it all together, just to recap briefly, this is way more complicated than just rates. You've got to determine what type of loan you're looking at. Are you looking at a conventional loan? Maybe an FHA loan makes more sense for you when you actually break down the numbers. That's the first step. Term. Are you paying the loan off quickly, or are you paying it off over 30 years or so? There's some advantages and disadvantages to both. Fixed versus adjustable. I think it's important that you at least consider that if you're not going to be in the property for more than a certain period of time, it might make sense to pay less if you're never actually going to face that adjustment period. PMI, as we saw, is much more complicated than just a monthly fee. I really hope that if you take away one thing from this video, it's make sure to look at your PMI options if you are putting less than 20% down, because the monthly option, just in my experience, is not always the best. In fact, it's very rarely the best. Finally, depending on certain factors of you as a borrower, there are some special programs out there that you might want to consider. And finally, of course, you do need to do an accurate comparison between rates and specifically, we can almost think about this from a comparison standpoint, you really want to look at the lender fees and the rates. Now, I say interest rate here and not APR. I'm going to make a whole other video only talking about APR because I'm going to explain why APR should not be used as your primary basis for comparing quotes against each other. I'll elaborate on that down the road. Finally, I'm available to provide a free mortgage consultation to you. You can call me or text me at this number. You can also find me on my website, bestmortgageanswers.com. I look forward to answering any questions that you have. Thank you very much.